Today we're going to take a look at Chapter 9, which is accounting for current liabilities. As a reminder, a liability account is going to increase with a credit and decrease with a debit. Now, a liability is a probable future payment of assets or services that a company presently is obligated to make as a result of a past transaction or events. The definition includes three crucial factors: past transaction or event, present obligation, and a future payment of assets or services. There are two main classifications that we use for our liabilities. One of them is current liabilities. These are going to be liabilities that are due within 1 year or operating cycle if longer. Long-term liabilities are due after 1 year or the company operating cycle. The first thing we're going to take a look at in terms of our current liabilities is sales tax payable. And with sales tax payable, mainly we collect the sales tax and we turn around and we pay it to the government. And so we're going to look at an example related to that. A retailer sells merchandise for $500 in cash on June 20th, and the cost of the merchandise is $300. The retailer collects 7% sales tax. We're going to record the entry for the $500 sale and the applicable sales tax. We'll also record the entry that shows the taxes collected and sent to the government on July 15th. So first thing we're going to do is June 30th, and there are actually two parts to this. One of them for the sale and one of them for the cost of the merchandise. You might remember that back in previous chapters. So first up, let's do the sale. We collected cash. We'll determine what that cash amount and the debit is in a minute. We're going to credit sales for $500, and we're also going to credit sales tax payable. We'll take that 500 times 7%, and we'll get $35. The cash will be $535 that we collected. The secondary part of this entry is going to be where we show the cost of goods sold as our debit, and that's for the cost of the merchandise at $300, and we credit our merchandise inventory for $300. Now on July 15th, when we pay the obligation for the sales tax payable, we're going to debit sales tax payable for $35, and we're going to credit cash for $35. Another example of current liabilities is unearned revenues. And we've seen these before, so we're going to look at a new example that we've got related to that. We have a ticket agency that receives $40,000 in cash in advance ticket sales for Sabrina Carpenter's upcoming 4-date tour. We're going to record the advance ticket sales on April 30th, and then we'll record the revenue earned for the first concert date on May 15th, assuming it represents 1/4 of the advance ticket sales. So, on April 30th, our first entry will be a debit to cash for $40,000 and a credit to unearned ticket revenue for $40,000. On the day of the first concert, which is May 15th, we're going to debit unearned ticket revenue for 1/4 of this, so we'll go $10,000, and we'll credit ticket revenue for $10,000. Our next example involves short-term notes payable. We've also seen some of these, so we're just kind of reviewing them for this particular chapter. In this example, on November 25th of the current year, a company borrows $8,000 in cash by signing a 90-day 5% note payable with a face value of $8,000. The first thing it wants us to do is compute the accrued interest on December 31st of the current year. They signed this on November 25th, so this is going to be 36 days. To calculate interest in our class, at the end of the year, we're going to take the 8,000 face value. We're going to multiply it times the 5% interest rate, and then times the 36 days that have passed out of 360. Now, always in our book, we use the banker's rule. We use the 360 as our denominator. So this gives us $40 in accrued interest at the end of the year. So we're going to prepare the journal entry for the accrued interest as of December 31st of the year. We're going to debit interest expense for $40, and we're going to credit interest payable that we'll pay when we pay the loan later for $40. Now, for the journal entry for when we record the payment of the note at maturity, this is going to be on February 23rd. For this one, we need an additional interest expense that I'm going to calculate down below. It's going to be 54 more days. So I'm going to do that one right here. I'm going to take 8,000 times 5% times 54 out of 360. And that's going to be an additional 60 in interest. I'll put a little star here. I'll put the star when we do it up here. So we're going to debit interest expense of $60. We're also going to debit the interest payable from last year of $40. And we're going to debit the note payable for $8,000. Our credit will be to cash for all of these combined, which is $8,100. The last thing we see in this chapter are payroll liabilities. Now, this is a new concept for this particular chapter, but payroll liabilities happen from salaries and wages earned, from employee benefits, and from payroll taxes that are levied on the employee and the employer. Down here, we just have an example of, from an employee's gross pay, the things that come out. FICA taxes for Social Security, FICA for Medicare, voluntary deductions, state and local income tax, federal income tax, and then they get to their net pay. Okay, so a couple things I want to talk about. First one being FICA. This is the Federal Insurance Contributions Act, and a main thing I need you to know is that it's paid by both the employee and the employer. Social Security is going to be 6.2%, and Medicare is going to be 1.45%. Now, the maximum that you can pay on Social Security changes each calendar year, so this is usually updated. Just pay attention when you're using the book to if they give you a maximum, but most likely in this class, we're not going to hit that maximum. We're just learning how to calculate them and use them. The Medicare has no max. Additionally, there is an additional tax if they make more than a certain amount. Again, you're not going to hit that amount in this particular class, but it is something to know should you go on to take a payroll class later on. Additional info on what is withheld from employees. Income tax. So employers have to withhold the employee's federal, state, and federal and state income tax based on their W-4 and their state 4. In our particular state, it is North Carolina, so the NC4. Withholdings are reported as current liabilities on the employer's balance sheet until they are paid. Voluntary deductions can also come from employee requests. Things like union dues, insurance premiums, 401k contributions, and charitable giving are things that you might see with this. Main things I need you to know with this. Up first, there are going to be basically two main big journal entries that you would see related to payroll. The first one is the employee payroll's expense and liabilities recording. We don't have numbers for this. I just kind of want you to have some things that are involved, okay? Typically, whatever the salaries expenses will be debited. Then we're going to have credits for FICA, one for Social Security, and one for Medicare. We are usually going to see one for employee federal income tax. And sometimes you might see employee state income tax or local. Additionally, any additional employee voluntary contributions. This would be like their health insurance or life insurance or 401k, those kind of things. And then finally, once you've reduced the salaries expense by all of these items, what you have left is your salaries payable. We'll see an example with actual numbers on the next page. When it comes to employers, they also have some payroll tax liabilities. First one is they're going to do a FICA match. And then they also are responsible for unemployment, which includes federal unemployment tax and state unemployment tax, or as you'll hear them called, FUTA and SUTA. Now, the employer payroll tax expenses and liabilities recording is typically going to look like this: a debit to payroll tax expense, and it will be the total of all the credits. We're going to include FICA, Social Security. We're going to include FICA Medicare. We're going to include state unemployment tax payable. So that's SUTA payable. And federal unemployment tax. Those ones are all going to add up to the debit. So unlike the one with the payroll expenses, the payroll tax expense is just levied on the employer and they just have that liability. We're going to look at an example on the next page. And coming over here for our reinforcement. A company's first weekly pay period of the year ends on January 8th. Sales employees earned $30,000 and office employees earned $20,000 in salaries. So that's $50,000 total. Employees are to have withheld from their salaries FICA Social Security taxes at a rate of 6.2%, FICA Medicare taxes at 1.45%, $9,000 in federal income tax, $2,000 of medical insurance deductions, $1,000 of pension contributions, and no employee earned more than $7,000 in the first pay period. That would have to do with FUTA. Okay, so we're going to compute the employee's payroll FICA liabilities. So we'll start with FICA Social Security. We're going to take the $50,000 that was earned. We're going to multiply it times 6.2%. We'll get $3,100. For FICA Medicare, we're going to take the $50,000 times 1.45%, and we're going to get $725. Now down here, we're going to record the company's January 8th employee payroll expenses and liability. So January 8th, we can just do salaries expense for $50,000. Then we move on to FICA Social Security. Of $3,100. FICA Medicare of $725. Federal income tax payable of $9,000. Medical insurance, so we'll just put it as employee medical insurance of $2,000, and employee pensions of $1,000. Down at the very bottom, what we have left for our credits is going to be salaries payable. So $50,000 minus all these deductions will be $34,175. Scooting that up. Now we will prepare the journal entry to record the company's employer payroll taxes resulting from this payroll. State unemployment rate is 5.4% on the first 7,000 paid to each employee, and the federal unemployment rate is 0.6%. So let's go ahead and do those as well. SUTA will take 50,000 times 5.4%. We'll get 2,700. And for FUTA, 50,000 times 0.6% is going to be 300. So let's do that journal entry, January 8th. These are all debit to payroll tax expense. We'll add that up once we've got the totals. We are going to do the match for our FICAs. So FICA Social Security being 3,100 and FICA Medicare being 725. Then we've got SUTA payable of 2,700 and FUTA payable of 300. We total all these up, we'll get 6,825 for our debit.